Most people think banks make money by keeping your deposits safe and charging a few fees here and there. But that's only a small part of the story. The real machine behind bank profits runs quietly behind the scenes, in the way they use your money, your data, and even your everyday habits. Let's start with the simplest part, deposits. When you deposit $1,000 into your checking account, it doesn't just sit there in a vault waiting for you to come back. Banks are legally allowed to lend out most of that money, usually over 90%, while keeping only a small fraction as reserves. That's called fractional reserve banking. If they pay you maybe 0.1% interest on your savings, but charge 7% on a car loan or 18% on a credit card, the difference between those rates is pure income for them. That gap is called the net interest margin. In the US, the average net interest margin across major banks in 2023 was around 3.1%, according to FDIC data. That might sound small, but when you're talking about trillions of dollars in deposits, even 1% means billions in profit. For example, JP Morgan Chase reported over $90 billion in net interest income in 2023, almost half of its total revenue. That's the power of using other people's money. Now, banks don't just lend to individuals. They lend to businesses, governments, and even other banks. Every time they issue a mortgage, a personal loan, or a line of credit, they're creating an asset on their balance sheet. Your debt is their income stream. When you pay your mortgage every month, part of that payment goes toward interest, and that's where the bank's real earnings come from. Here's a simple way to think of it. If you borrow $300,000 for a house at 6% interest for 30 years, you'll end up paying roughly $347,000 in interest alone. That's more than the house itself in many cities. Multiply that by millions of borrowers, and you start to see how banks quietly build enormous wealth from long-term lending. But loans aren't the only source of profit. Banks are also fee factories. Think about how often you pay for convenience. Overdraft fees, ATM fees, late payment fees, wire transfer fees, foreign transaction fees. In 2022, U.S. banks collected over $11 billion just from overdraft and non-sufficient fund fees, according to the Consumer Profit Protection Bureau. That's money made not from lending, but from the friction in your financial life. Every time you miss a due date or swipe your card abroad, the bank earns a little extra. Some of these fees are being reduced under regulatory pressure, but banks always adapt. They introduce new kinds of charges like account maintenance fees or inactivity fees to make up the difference. It's a quiet cycle. Regulators push down on one source, banks open another valve. Then there's the invisible income stream that most people never see, the money they make from payments themselves. When you use a debit or credit card, the merchant pays something called an interchange fee. It's a small percentage of every transaction, typically around 1 to 3%. That fee gets split between the card network, like Visa or MasterCard, and the issuing bank. So when you buy a $100 pair of sneakers, the retailer might only receive $97. The rest gets sliced up behind the scenes. Multiply that by billions of daily card swipes, and you realize how banks profit every time you spend, not just when you borrow. And don't forget about credit cards themselves, the crown jewel of banking profitability. Credit card interest rates in 2024 have averaged around 21%, the highest in decades, even while savings accounts pay around 4 to 5% at best. That huge spread is where banks thrive. In 2023, Americans collectively owed over $1.1 trillion in credit card debt. If even half of that balance carries interest, we're talking tens of billions flowing back to banks every year. Credit cards also come with annual fees, balance transfer fees, and penalty interest rates. They're marketed as lifestyle tools, but in reality, they're one of the most lucrative consumer products ever created. Now, let's look at something more subtle: how banks profit from your data. Every time you log into your mobile app, check your balance, or make a purchase, you generate data points. Banks analyze this data to understand spending behavior, credit risk, and even marketing potential. They use predictive models to decide what loan offers to push, which customers are likely to accept them, and what interest rate will maximize profit while minimizing default. Some banks partner with data analytics firms to sell aggregated, anonymized insights to businesses. For example, they might tell a retailer how spending in their category has changed by region or season. That information is valuable, and yes, it's another way your banking activity turns into revenue. Another major income source comes from the financial markets. Banks don't just hold deposits and make loans, they actively invest. They buy government bonds, corporate securities, and other assets that yield returns. When interest rates rise, as they did sharply between 2022 and 2023, banks can earn more from those holdings. But there's a flip side. Rising rates also make older bonds less valuable, and that's exactly what caused trouble for some regional banks in 2023, like Silicon Valley Bank. They held too many long-term bonds that lost value when rates climbed. Still, the big banks are usually diversified enough to manage those risks and often profit from trading and investment banking activities too. Investment banking is another beast entirely. When a company wants to go public, merge, or issue new debt, it hires a bank to arrange the deal. The fees for these services can be enormous, sometimes millions for a single transaction. In 2021, global investment banking fees reached around $160 billion, according to Refinitiv data. Even though that number dipped after markets cooled, it remains a major pillar of profit for financial giants. Then there's asset management. Banks like Goldman Sachs, Morgan Stanley, and Citigroup manage trillions in client assets, charging a small percentage every year, usually around 0.5 to 1%. That may not sound like much, but on $1 trillion, 1% equals $10 billion in annual fees. It's steady, predictable income, and it grows with the market. Even retail banks have joined in, offering robo-advisors and mutual funds that quietly generate management fees from your investments. Let's not forget the role of technology. Digital banking has reduced operating costs dramatically. No more expensive branch networks in every neighborhood. Online banks can serve millions of customers with just a few data centers and a customer support team. That efficiency translates directly into higher profit margins. For example, Ally Bank and Chime have grown rapidly by offering competitive rates and minimal fees, while keeping overhead low. They make their money primarily from lending and interchange fees, proving that even in the digital age, the old banking model, earning off your money, still rules. Now, you might wonder, if banks make so much money, why do they still need to charge us so many fees? The answer is competition and shareholder pressure. Publicly traded banks are judged quarter by quarter. Investors expect steady growth even when interest rates or loan demand fluctuate. So banks diversify their income streams. If lending slows down, they push more credit cards, more investment products, or new service fees. It's a constant balancing act to keep profits rising. Let's take a real-world example. Wells Fargo, after a series of scandals, shifted focus toward consumer banking and wealth management. In 2023, about 60% of its revenue came from interest income, but the rest came from fees and services. That mix helps cushion the bank against downturns. If fewer people borrow, fee income still keeps cash flowing. It's a strategy most large banks now follow. Another way banks quietly profit is through something called the float. When you deposit a check or transfer money, it doesn't always move instantly. During that short time, your money is still technically in the bank's system, earning interest for them, not for you. Even a one-day delay, multiplied across millions of transactions, can generate meaningful returns. Payment processing times are shrinking with new systems like FedNow, but the float still exists, and banks know how to make the most of it. Speaking of interest, let's talk about how rate changes affect bank profits. When central banks raise rates, borrowing becomes more expensive, but banks also earn more from the loans they already made. Meanwhile, they're often slow to raise deposit rates for customers. That delay creates what analysts call lag profit. In 2023, for example, the Federal Reserve raised rates above 5%, but many banks still paid less than 1% on traditional savings accounts for months. That spread added billions to their bottom lines. It's not illegal, it's just part of the system. Banks adjust at their own pace, and customers who don't shop around end up subsidizing those profits. Then there's the way banks use your loyalty. If you've been with the same bank for 10 years, chances are you've accepted lower interest on savings, higher fees, and maybe a card you rarely use. Banks rely on that inertia. They know that switching takes effort, and most people simply don't bother. According to a 2023 survey by Morning Consult, more than 70% of Americans still bank with the same institution they joined over a decade ago. That kind of customer stickiness is worth a fortune. It allows banks to keep margins wide without losing clients. Of course, not all bank profits are bad news. Healthy banks keep the economy running. They provide credit for homes, businesses, and infrastructure. They're essential intermediaries in a complex financial system. But understanding how they make money helps you see where your own financial opportunities lie. For instance, if you know that your bank earns more when you carry a balance, you might prioritize paying that balance faster. If you know they pay little on deposits, you might move your savings to a high-yield account or a money market fund. Awareness is power. And it's also worth noting how technos are changing this landscape. Companies like PayPal, Block, and Revolut are blurring the line between banking and technology. They offer instant payments, low-cost transfers, and sometimes better rates. Traditional banks have responded by investing heavily in their own digital platforms. But the underlying profit engine remains the same: using customer money efficiently and charging for the convenience of doing so. Now, let's consider the global picture. In emerging markets, banks often earn even more from lending because risk premiums are higher. In countries like Brazil or India, loan interest rates can exceed 20%, while savings accounts pay less than 5%. That spread fuels rapid profit growth, but it also increases inequality between lenders and borrowers. That's why regulators worldwide are paying closer attention to banking margins and transparency. When you zoom out, the entire banking system is built on trust. You trust that your money will be there when you need it. Banks trust that you'll repay what you borrow. Between those two promises lies a web of transactions, fees, and investments that generate steady profits year after year. It's not magic, it's math, scale, and psychology combined. So how can you turn this knowledge to your advantage? Start by understanding where your money sits and what it earns. Compare interest rates, question monthly fees, and don't assume your bank's standard offer is the best one. Remember, every percentage point you save or earn is a percentage point they don't keep. The more financially aware customers become, the more competitive the system has to be. And while you're learning how the money system really works, make sure you subscribe so you don't miss the next deep dive into the mechanics of finance. Because the truth is, banks have mastered the art of making money from money and from you. They do it through lending, fees, data, and even timing. They thrive on scale, trust, and complexity. But once you see the blueprint, the mystery fades. You realize that every swipe, every deposit, every loan payment is part of a much larger ecosystem designed to turn your financial activity into their profit. The next time you walk into a branch or open your banking app, think about what's happening behind the screen. Your balance is not just a number, it's a resource being put to work. For them, it's an engine of income. For you, it's a reminder that money never really sleeps. It just keeps moving, earning and circulating, and the banks are always there to collect their share. That's how banks really make money off you.